Welcome back. Happy Monday. Hope everyone's doing well. Today, we want to take a look back at some of the performance of our major commodity and financial markets. Specifically, we know that late last week on Friday, we had a very big sell off in equities. It's continued today. The daily change for the NASDAQ 100 Volatility Index, similar to the VIX index. The NASDAQ was up 13%. The VIX, the Volatility Index, also known as the Fear Index, was up 17% in one day, making 31 or 24 and 31% respectively for the week. Now, as stocks go down, which they have, the fear indices like the VIX and the NASDAQ Volatility Index go up. These indices are essentially, the VIX is calculated using the prices of the options on the S&P 500. Traders tend to buy options as a hedge when stocks go down. So when stocks go down, the VIX and the NASDAQ Volatility Index go up. But really try to put in perspective on how significant this is. The blue line over here, of course, represents the NASDAQ, and then the VIX daily changes. And these are the biggest moves we've seen over numerous commodity markets and financial markets, in the recent past. Now, just really quickly, you can see here on the S&P 500, sharp move to the downside, the VIX moving up, as is the NASDAQ Volatility Index. We've really seen, a turn to the downside for equity markets and other related markets. However, interesting enough, take a look at the correlation between, for example, the VIX and different financial markets. Now, over here is the VIX. Now, of course, we would expect when the VIX goes up, stocks go down. There is almost a perfect inverse correlation, 98% inverse correlation between the VIX and the S&P 500. When the VIX goes up, stocks go down. Okay, that is not unexpected. However, take a look at the positive correlation between the VIX and kerosene, 64%. A 72% correlation, positive correlation between the VIX and diesel. And a 78% correlation, positive correlation between the VIX and heating oil. Now, whether this is causation or just a coincidence, we'll leave that answer to the fundamental analysts. But we should recognize that these markets are moving in the same direction. As stocks go down and the fear index goes up, so do these commodity markets. Interesting, propane doesn't really join in this party. Almost a zero correlation in either case. And gasoline did go down as the VIX went up. So, again, we're going to have to leave that to the fundamental analysts to figure out why gasoline and heating oil and diesel and kerosene are moving in opposite directions to each other, or opposite directions to gasoline, I should say. But with that said, we can take a look at the positive correlation. This is between the VIX and gasoline. Well, there was a pretty strong correlation, but gasoline did not participate when the VIX shot up last week. However, compare the VIX. Now, the VIX is the blue line, the blue histogram bars. Compare the VIX to kerosene. As the VIX went down, so did kerosene. As the VIX shot up, so did kerosene as well. The VIX and diesel, very strong correlation to the upside. And the VIX and heating oil, a very strong correlation as well. Now we can see gasoline, long steady trend to the downside. On the lower end between the 20 simple moving average and the lower Bollinger Band, no real signs of a reversal so far in that market. However, take a look at kerosene. Long steady trend to the downside. Now we've crossed above the 20 simple moving average. The Bollinger Bands have very much contracted. And usually Bollinger Bands contract before the market is set to make a big move. Volatility is very quiet so far in kerosene. Same holds true for diesel. The last closing price actually is a little bit above the upper Bollinger Band, and heating oil as well. Very, very tight Bollinger Bands, which indicates we may be due for a large move. If history holds true, we see a breakout to the upside above the upper Bollinger Band. We may see a follow through as these commodities continue to gain strength. Now, take a look at kerosene over here. This is certainly not calculated every single day. So these prices are calculated every several days on our Federal Reserve St. Louis website. However, the last report is the highest number we've seen over the past 10 reports on kerosene, 348.9, 348.9. Diesel as well, 370. Highest high we've seen over the past 10 reports. Also heating oil, 360, 359. That's the highest report as well. Certainly seen a big reversal in these commodities back to the upside. Notice gasoline, it's near, I would say near the higher end of the range. Actually, yeah, near the higher end of the range, but definitely not breaking out the way those other commodities have broken out as well. So it'll be very interesting to see if equity markets continue south, if that is also going to be the case for these other financial markets, or I should say commodity markets, to move to the upside. Also, take a look at the bond markets. Now, top right-hand side, the red line represents the total bond yields. That's as if you were to add up the 30-year yield plus a 20-year plus a 10, etc. That's the red line. Those continue to rise. This just shows us how much more investors are receiving by paying, when they're purchasing bonds. The blue line represents the S&P 500. Now, a fundamental analyst would argue, yes, the equity markets are now going down, at least as of last Friday, are going down in fear of very high interest rates or much higher interest rates moving forward. That's what we heard last Friday. So this graph really does confirm what we heard in the news last week. The chart in the center over here, the red line represents the total bond yield, the same chart as before. The green line represents the spreads between those yields. So we have the 30-year minus the 20-year. We have an inverted bond yield of 0.25%, 25 basis points. We have a positive relationship or spread between the 20 and the 10 at 0.38. However, if we take a look at all of the different bond yields, the 30 to the 20 to the 10, etc., those are contracting. Contracting bond yields tend to take place when there's uncertainty in the market. Investors aren't willing to go out there and take the extra risk to buy the 30 instead of the 10-year, or buy the 10-year instead of the 3-year. So that's why bond yields tend to contract when there's less of a spread between long and medium, or medium and short-term bonds. And that's something that's very interesting, this phenomenon that although yields are rising, the spreads between the different maturities are not rising. In fact, they're contracting. And for me, that tells me that there's trouble in the future. Now, we can also take a look at the correlations. Very strong correlation between the black line, that's the S&P 500, and the orange line, which is the 30-20 bond spread. Very interesting to see how that has held true. Also, the S&P 500, near perfect correlation between that and the 20 and the 10. So, of course, these correlations may not last forever. However, for the time being, we really can use the bond spreads to confirm whether we think equity markets are going to continue, in this case, lower, or maybe reverse back to the upside. Finally, take a look. Left-hand side of the chart shows us the rate of change for one day on the different 10-year bond yields across the world. The Japan bond yields, that's very low interest rates, of course, moved up 9%. Germany around 8%. Take a look at the U.S. bond yields. That's all the way on the left-hand side. Bond yields up 3%. And that really reflects, I think, a continued expectation of higher interest rates, as the Federal Reserve has really stated that their primary focus is to look for inflation to cool. And I don't think they're going to let up on the gas pedal until they see signs of that happening. Interesting, last week we saw, the PCE, personal consumption expenditure, that's an inflationary number. That cooled down a little bit. Before that, earlier in the week, we had durable goods. But one report does not make a trend. And as far as the Federal Reserve is concerned, we may continue to see higher interest rates. If that's the case, we would likely expect to see lower stocks, higher total bond yields, not necessarily the spread. But again, Will the correlations hold true? If they do, and we expect stocks to go down, and therefore we expect the VIX, the volatility index, to go up, could we also see commodities like propane, diesel, heating oil continue to rise? Will gasoline start to follow those other commodities as well? All these questions will have answers as the markets play out probably this week. We hope this has been helpful. We'll see you again soon.